What's going to happen then with Pfizer? Let's start there, and let's try and get into a bit of what you presented this morning and why you feel that it's undervalued and that you have an opportunity here to perhaps work with management to make its stock go higher.
Yeah, look, Pfizer's a great company, a great American company. And we have an opportunity to be able to buy into the company at 10 times earnings, almost a 6% dividend yield. And so you have to ask yourself, why is it so cheap? And of course, everybody remembers Pfizer right now, and it's most known for the great job Pfizer did during the pandemic. We're here without masks, talking to each other in person in part because of the great job that they did. During that period of time, their revenue jumped. It went from $40 billion to $100 billion. Their cash flow jumped from roughly $10 billion to, let's call it $40 billion. There was huge growth and huge cash flow generation. But, something's not working because the stock has gone from 41 to 29 during that period of time.
So what's not working?
Well, when we dug into it, there's a few components, but the biggest one is their return on invested capital. So for any company, public, private, anything, you have to have the right return on invested capital. You're responsible for managing the investments, the shareholders' investments, and get the right return on that. For a pharma company in particular, it's incredibly important. They're investing large sums of money in R&D as well as in acquisitions, which is really outsourced R&D. And the way you should be measuring those returns is in the expected growth that they're going to produce. And when we look at it, the growth they're producing from their investments is worst in class. And that doesn't make any sense. This is Pfizer. So if they get a drug approved, they're best in class, if not near best in class, in manufacturing, marketing, distribution. So they should get the revenue side. The challenge has been on making sure in their pipeline, they're spending money on the right projects and getting those projects to fruition.
But prior to COVID, I can recall that there were similar concerns to a certain extent about Pfizer. And so I wonder, then they obviously used a lot of that COVID-free cash flow that you mentioned to go out and buy things. But isn't it a bit early to try to be judging whether they're ultimately going to get a return, for example, from something like Seagen, which was a $43 billion deal? I mean, that just closed not that long ago. Why are you in a position to question at this point whether they ultimately will get the return that they thought they would from that deal?
Yeah, well, look, people can look at our slide deck. It's up on our website at starboardvalue.com. But what we've done is we've gone back and taken a look at how they've performed versus their own expectations, and how they're expected to perform according to Wall Street consensus analysts. Now, for sure, those aren't right. So could they do better? Of course. But part of the challenge here is in credibility. So they're either not going to produce, or investors and research analysts don't believe they're going to produce what they hoped to produce. So let's use the acquisition as an example, and not just Seagen. And by the way, and I said this at the conference. There's nobody more excited and more bullish and who would be happier if all of this produces amazing results. We're not anti anything they bought. We're not anti anything that's in the pipeline. We're excited about what's there. We bought the stock. We get to buy it at this price because we think the future will be better than people think.
Right.
So I hope Seagen is enormously successful. That being said, they paid $70 billion for the several acquisitions they did right after COVID. Seagen being the largest at $43 billion.
Yep.
They came out at that time and they said those acquisitions were going to produce at least $20 billion in revenue in 2030. So as a good analyst, we put multiples on everything. So $70 billion divided by $20 billion is 3.3 times. So they paid 3.3 times.
Yep.
We looked at other pharma companies that have bought anything for over $1 billion, and most of them pay closer to 2.4 times. So they paid more.
Okay.
Fine.
May have overpaid. It doesn't mean that they're not going to get the return.
Right. And presumably they overpaid because maybe they thought it was going to do better than $20 billion, and they're only promising $20 billion. But the problem right now is that the $20 billion they said they were going to get in 2030, Wall Street consensus believes is going to be $13 billion. So it's not more than 20. Right now the consensus estimates for the revenue from those acquisitions is $13 billion, which really means they paid 5 times that, not 3.3 times that. Now, again, that value destruction, and it is value destruction by overpaying for something and not getting the results, that's in the past.
It is.
I'm not actually worried about that.
I know. So so as a activist investor, what is it that you believe you can do to improve the potential return from things that are already going on in the pipeline that are already kind of baked, so to speak?
Well, everything gets approved in the pipeline and baked every day. They're making new decisions today and tomorrow for the future. A company's value is based on shareholders' expectation of future results for the company. I can't do anything about what happened in the past, but I can use the past to inform current decisions. And something inside Pfizer isn't working right in their discipline around the investment spend that they're making.